Good morning.
Morning.
Have you got coffee on board?
No, but I will. I'll be okay. Yeah.
Awesome. I'll admit.
Fiona, can you just confirm, do you have admin rights there as well?
Well, I must do because somebody just popped it. Oh, it was Nick. Hi, Nick. Welcome.
Hello there.
Yeah.
Really good,
Yep.
thank you. I'm Fiona, and this is Jonathan Mason, the chairman of the council.
Yep.
Yes, I know Jonathan from past lives.
Absolutely.
Wonderful.
I can still remember a early TV thing we did, like Morning Report or something. Yeah.
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 So, Natalia, I must have admin rights, I guess, still.
Yeah, you should do. I did allocate admin rights to you.
All right, but will you admit people, or do you want me to?
Yep. Nope, I'm on it.
Great, thank you.
Okay. And Fiona, in the unlikely case that something happens to me at my end, you'll just take over.
Sure, no problem.
So yeah, I'm in Germany. Well, a meeting yesterday worked fine. You never know. Small town in Germany.
And did the opera start last night?
Started Sunday. I had a free day yesterday, but the last three start at 4 and end at 10:30. It's a reasonably long day. Yeah.
That's Nick. Jonathan's at the longest opera in history, literally run over a series of days.
Called the Ring Cycle. So Richard Wagner, Ring of the Nibelungen. Yeah. So, but it's been fun.
Good. Okay, so we've got about 17 or 18 people scheduled to come. So we might just take a minute and let people join us. It's not quite 4 o'clock yet.
Okay.
How's life in the banking world, Nick?
Well, sort of still keeping very, very busy. I think it's sort of been one of those environments where even when life may be quite slow, it's still quite busy with the myriad of just the environment's like any business. The environment's quite changeable and choppy. So we've always got our hands full at the moment, it seems.
Each day. Hi, Mark. Welcome.
Hi there.
Hi, nice to see you. Hello, Mike Hearn. Hello, Fran O'Sullivan.
Good afternoon, Fiona. Good to be here.
Hello.
Hi, Nick. Good to see you, mate.
Hi. Long time no see.
Yeah, been a while.
Very good. Hi, Mark. You've come back to Earth after your space trip?
Yeah. No, Blue Origin, fantastic US company. It was really, really great to spend a bit of time with them in Texas.
Just looks so exciting. It must have been the biggest buzz when you got back to the ground.
Well, the trip itself was pretty cool as well.
I bet it
but
was.
no, it was amazing.
And how long were you up in the whichever stratosphere it was?
So we got to the Kármán line, which is sort of designated space, about 100 kilometers altitude. And the whole flight is only 10 minutes, so a very, very short experience, but very intense.
I bet. And did you have to do a lot of training beforehand?
There was a couple of days of training, so pretty easy, but just getting used to the mission profile and some of the aspects of the capsule, getting in and out, emergency kind of situations, fire situations, that kind of thing.
Very exciting. Not very many people have had that experience. All right, we still got. Hi, Mike. How are you? Mike Atkins.
Yeah, I'm well, thanks, Fiona.
Yeah, nice to see you.
Likewise. G'day, Nick. How you going?
Good.
People off as we go. Simon Bridges, how are you?
Hello, hey, good, nice to see you all.
Nice to see you. Jocelyn, hi, welcome. Still got a few more people to come, but it is 3 minutes past. So, Jonathan, I think we should probably go for it because
Okay.
the discussion.
Okay. Second, here we go. Okay. Coach Jonathan Mason, Toko Inglewood, Tanakoto, Kachoa. Welcome, everyone, and thank you all for joining us. I'm Jonathan Mason, Chair of the New Zealand United States Council, and I'd like to welcome our special guest, Nick Tuffley, Chief Economist at ASB. ASB joined our council this year, and we are delighted to have them on board. And I'd like to thank Mike Atkins, Head of Trade Finance at ASB, for making this meeting happen. Nick Tuffley has had a long history of involvement in the New Zealand banking sector and has been ASB's chief economist since 2007. He and the economics team provide regular analysis of economic developments and what the world looks like, both through written publications and on the media, with a key objective being specifically to help the bank's clients to make better informed business and personal finance decisions. And his teams have won several awards for the accuracy of their economic forecasting. So that experience and background is very helpful us for today as we consider the economic outlook in the United States and whether their current trade and economic policies are likely to make trade and the U.S. economy great again, and if so, for whom? So we were in Washington a week ago with some council members and friends, some of whom were on this call, and talked with quite a bit of people. But over and above our Washington visit, I mean, we've watched a market that back in March and April was down close to 15%, equity market, with the bond market, 10-year Treasury close to 5%. And here we are 3 months later with equities back at breaking record highs, maybe 4 times this past week, with the bond market, 10-year Treasury, being relatively well behaved in the 4.4% range. And so even the market has had very different views on trade policy. So President Trump is emboldened based on the current market settings, the current market levels that I've just talked about, but it isn't necessarily the end of the story. So looking forward to Nick on where he sees this all heading. And then Nick, I don't know what you thought, but sort of maybe after about 20 minutes, we turn it back over to the audience for Q&A and conclude at approximately 5 o'clock. Does that sound like an okay plan?
Yep, sounds good. I've got some opening stuff to sort of talk through on the trade and a couple of minutes on New Zealand, and yes, we can take it from there.
Good.
All right. So what I will do is I'll just, because a picture does sort of paint a 1,000 words, so I will just get up some slides there, and I'll just get it all up and running. So I'm hopeful you can see a title slide up on there.
Yes, I mean, I can see it.
Great, thank you. So look, what I'll do is, I suppose, as Jonathan, you've sort of framed it up sort of very well, that sort of making trade great again, or perhaps the other way to look at it from the American point of view is, will tariffs make America great again, which is the slogan on the hat, which we're all familiar with, and what will it do for the global economy as well. And there's far more in the discussion you can go on to beyond sort of trade, in the sense of, well, what does this actually mean for global relationships between countries? And I think particularly groups of countries which have tended to band together in the past, now looking at a fractured or a fractious relationship with some of those members now as well. And so there are a lot of political implications out of that for sort of what sort of world we have going forward, potentially. So look, without further ado, I'll just sort of start wading my way through on this, if I can get it to, I've got someone trying to come in by the look of it. Okay, and so look, I'll just sort of start on with things, and I think I'd sort of step back and just that sort of very high level part. And obviously, those of you who've had conversations will have sort of, particularly in Washington, will perhaps have some insights from there. But if you're looking at it from the outside, look, what are some of the rationales for putting into place the tariffs? And the one that we have heard talked about an awful lot is the notion that putting in place tariffs is going to bring manufacturing jobs back to the US in a sense, and that's somehow going to bring some benefits to the US over the longer terms through that shift towards more investment, a bigger manufacturing sector, and more jobs in that sector coming through. Now, part of the rationale at times also seems to be to raise revenue to help pay for the tax cuts that are sort of being pushed through, although there's a bit of a tension between these top two things, because the more that you have manufacturing shift to the US, the less imports you have, and the less you're essentially raising in tariffs potentially as well. And another part just seems to be, and you've seen this particularly with the way that there's been the focus on China in the past, the restrictions on technology to China, is also about this tension you have between China and the US for, I guess you say, who's the global superpower, as some of the reasons why we are where we are. And impacts for us to think about. Look, it really does look like we're going to have weaker global growth this year and some lingering impacts next year. And, particularly in the US, which I'll talk about a little bit more. Also, some of the countries that are most exposed to trade with the US, which is Canada and Mexico, where a very significant proportion of their economies are in effect geared towards exporting to the US. And we've also got the question mark around China, where only about 3 to 4% of its GDP is actually exposed to the US market. So it's relatively small compared to other countries, but it does come down to sort of what tariff is there on the end in terms of the impact. And for us, that's probably the one which we also need to be watching for. On the inflation front, there is that expectation we'll see higher inflation in the US, but probably lower inflation elsewhere. And that's what a lot of central banks are working through at the moment, is that you may have some forces that push inflation up in the short term, or may pull it down in the short term, but to the extent that your export growth is slower, you're likely to have slightly lower inflation pressures over time. And that's what most central banks seem to be focusing on, such as ours and the ECB, for example. Now, We may also see changes in trade flows, both in the short term and the longer term. So in the short term, to the extent that people are finding it more difficult or more challenging or just unviable to export to the US, we may well see goods flow to other countries, and that's that potential here for us to perhaps find that we end up with more Chinese manufactured goods that no longer go to the US, even if it's for a short period. We may find that all of us are trying to sell our wine into the UK market instead of the US market, as we sort of redirect trade around. So we may get some benefits from what's happening through lower prices of things that we normally buy, but we may find we've got stronger competition in other markets. We may find we've got more opportunities in other markets where, say, US exports are no longer getting as much access as they used to. And longer term, one of the things that many countries are likely to be thinking of is just the risks of trade with the US and heavy dependency on the US, and looking to change that over time. And that is where we may see a lot more focus on people developing export markets beyond the US to just try and get a bit more diversification, which, as we know from trying to diversify away from China, it's not necessarily that easy to do. And one of the ironies for us is that we have grown our trade quite substantially with the US, even as we've pulled back on trade with China, only to find that probably we've got some things to be thinking about with both those markets going forward. So, look, if we just have a look at, well, what is the significance of the tariffs in the US? If we go way back into the the 19th century and even before then, the US basically relied on tariff revenue for its sort of federal government funding. It's back in the good old days where knowing what someone earned and being able to collect the money off them in the form of tax was pretty challenging. So up until pretty much that sort of right before World War I, you basically had a US federal government heavily reliant on tariff for its income, until they passed an amendment in 1913 that allowed for federal income taxes. And it's pretty much from that moment on, apart from that Great Depression period of protectionism, is where you've seen tariffs in the US have fallen to very low levels, where it's sort of effectively down to a couple of percent. We're likely to be somewhere around about 15-20%. Is where the average US tariff rate is likely to lie. So you can see that is basically going back. You had a peak of 19.8, to be very precise, back in about 1935. So tariffs look like they're heading back to that sort of level that we last saw in the Great Depression. So we're winding the clock back about 80 years or so, in terms of what that means for both the US and for its trading partners as well. So the other dimension with what's happening is as Jonathan was alluding to, back in March and April, we saw just really heightened uncertainty. So sort of a couple of measures of policy uncertainty just sort of really show what the start of this year has been like. So when you look at US economic policy uncertainty, it is literally off the charts. Admittedly, it's only a sort of short series of time. This other measure of just more general economic policy uncertainty, it basically hit the highest level, or basic level that exceeded what we hit during the COVID times as well. So it just sort of shows just what a kind of psychological kind of shock the talk of tariffs, the enactment of tariffs has been, and just how much uncertainty it triggered for a time, particularly with some of the levels that the reciprocal tariffs that got announced got to as well. So that sort of set this context for just that challenge around uncertainty and what a killer of decisions that can be, and even just that uncertainty impact, if it continues to linger, can do quite a bit of damage to economies. But hopefully, with where we're going this week, we are going to get a lot more clarity for many countries over just where tariffs are sitting. We've seen some of the more high profile and important broad brush agreements being announced, but we're still obviously missing the one with China, which is pretty key for us. So look, what does this all mean? Look, we were probably looking forward to a year this year and next year growth was likely to be benefiting finally from the taming of inflation, the global economy came under a lot of pressure from those very high interest rates we saw in mainly the developed world. Interest rates were starting to come down as inflation was coming down. We should have been seeing economies sort of picking up, and instead what we've got is a period where growth is likely to be a lot slower than otherwise, and it sort of ranges sort of across the board. But some various estimates are, US growth for this year, instead of say being somewhere around about 2 or slightly above 2, is probably going to be a little bit above 1 or so, as an example. China's growth probably a few tenths of a percent lower by the time you account for some added stimulus coming through. So look, what is happening is likely to be, in the short term, when I say the short term, probably the next year or two, slowing that recovery, basically halting or delaying that recovery that we should have been having after getting on top of inflation. And the impacts are obviously much bigger in places like Canada and Mexico are going to be quite heavily exposed. Some estimates that our CBA colleagues did for New Zealand and Australia showed we're probably somewhere around about 0.2% off GDP, with what if you get a tariff settling somewhere between sort of 15 and 20%. So not bad in the grand scheme of things compared to a number of other countries. But obviously, what's happening is coming with a cost. And obviously in the US, you're paying more for what you are importing. You've had huge uncertainty about the availability of product. You're still facing an environment where, for a number of domestic US manufacturers, some of their input costs for steel and aluminium are considerably higher now as well. So quite a few impacts to be working through, and potential pressure on profitability to come as well. And so I think one thing that's also going to matter for the US is that perception as well. And so look, one thing I've just highlighted up here is just flows of short-term visitors into the US. And it's a bit hard to tell what's happening with some of them. So I've got all the individual countries are on the left there. But Canada next door, you can see just on an annual basis, it looks like you're already, and that their data only goes up to April, already seeing like a drop in visitor arrivals coming through. You're seeing some tentative signs of that coming through from China and Germany as well. So there does seem to be a little bit of an impact for the US, in the sense of people being less inclined to, say, visit the US, and possibly less inclined to buy some US products as well, with what has been happening. So, one of the other sort of flow-on impacts, obviously, is that sort of reputational impacts outside of the US through what has been happening. Now, I'm just going to turn it back and just look at what's the so what for New Zealand. So, look, for us, we've got about $9 billion worth of goods exports to the US, and about $1 billion goods trade surplus with the US. Our services exports, the US is our biggest market for services. We've got about $7 billion worth of exports of services. A big chunk of that is tourism, but there's quite a lot of business-related services in there as well. And a lot of that will be some of our sort of technology-related services that we're providing, whether it's movies and software and other things. And we run a $3 billion services surplus with the US. So we're quite fortunate that services haven't been caught up. But obviously a big chunk of that is tourism as well, which I'll talk about. But fortunately, it's just that $9 billion. So we're looking at it, the tariff bill, whether you want to decide who's paying for it, we're looking at somewhere in the order of about $1 billion in a $400 billion economy. So there are some impacts there, and I can talk through those in a bit more detail. The indirect export impacts is the bit where we still don't quite know where things end up. And what matters there is that if, say, China finds that its growth is being impacted quite a lot by the tariffs that it's facing to the US, its economy slows, its consumer spending slows, that will flow through to our exports potentially. So just seeing what happens to China's tariff levels, how well their economy holds up, how much government stimulus is put into place, all those things are going to matter. And some of those impacts may be bigger than the direct impacts that we have with our own exports to the US. We just don't quite know the answer to that. But some of the risks are fading a little bit with some of the tariff prices that we're seeing. Global price impacts, another channel. Look, anything we're buying from that's made in the US, particularly if it's made out of metal, could be more expensive. On the flip side, I talked before, look, we could find that there's opportunities to buy things cheaper from countries like China. The exchange rate, how that behaves in response to all the uncertainty and what happens with that volatility, that can matter too, but the exchange rate's been pretty well behaved. So we're probably not getting knocked around too much on both our exports and our imports on that front. And the final one is sort of confidence. Look, I think from a New Zealand point of view, we're coming out of a deep recession, a number of years of feeling pain. We've now got this added uncertainty. The more that uncertainty feeds through into people being cautious and wary means that it could, delay our own recovery. So business confidence here, and people, I think, just putting what's happening in the US into perspective for what it means for their businesses is sort of really important at the moment. Because it's always easy to find something to worry about. So I sort of think about my mum, and I think if she didn't have anything to worry about, she would get worried because there's surely something that she was missing to be worried about as well. But sometimes, for some people, there may not be that much to worry about. For others, they'll clearly have a lot of things that they're already working on and changing quite markedly now because their businesses are getting impacted by it. But that confidence channel is pretty important. So I'll just sort of run through, when we're looking at our export basket, first of all, what we've got to sort of really focus on is, in that sort of black line, our meat. So around about $3 billion worth of meat exports to the US, a lot of that's beef. Probably one of the things, the practicalities around our supply of beef into the US at the moment is if anything, we've got a challenge getting enough livestock to slaughter to send. So probably a bigger issue is our ability to supply to meet demand, rather than necessarily finding that we're losing a lot of sales because of the tariffs through there. And a lot of our meat does go into hamburgers, so it's a small part of the overall consumer influence on the final consumer price as well. So we may find that areas like beef don't get affected too much. It's probably more the premium cuts which are more at risk. Another biggie is dairy, and a lot of that apparently is some fairly sort of specialised proteins, so that may not be as impacted. And that blue line on that sort of second chart down there, that's our beverages, and a lot of that's wine. And the US is our biggest single market for wine now. It's overtaken the UK, and that's the market that's probably a bit more vulnerable, particularly for bottled wine, where what's going across the border and having a tariff put on it is pretty much the final consumer product. So the tariffs are likely to have a much bigger impact on the final selling price as well. So that's probably where the challenge is. But we do export quite a number of other things, including a lot of like electrical and electronic machinery. But the big ones we've got to remember, it's meat, dairy, and wine. And tourism is significant. It's about $2 billion a year, but for the time being, that's escaping the tariff. So that's sort of, to put it in context, those are the big four we need to probably focus on the most. But tourism, obviously, not one that's sort of directly in the firing line, at least at the moment. Now, we have seen, when we're looking through data, and we've sort of seasonally adjusted to try and get the sort of remove the sort of normal sort of seasonal impacts of the year, and very sort of tentatively, we have seen some signs that instead of running at, say, $850 million a month in the sort of first few months of this year, we've now sort of dropped down to somewhere around about $700 million a month. And we can see that it does look like meat's been one where we've seen a bit of a fall coming through in our exports to the US, admittedly after quite a bit of growth from late last year, and some signs that dairy has eased back as well. So we are seeing some tentative signs over April and May that there has been, May and June, I should say, that there has been a slight pullback. But it's a bit hard to decipher whether this is just a bit of seasonal noise, particularly when we're talking about agricultural products as well. And also, look, it's quite possible that we did get extra export shipments away earlier in the year to just try and beat the tariffs when there was a lot more talk around them. So at this stage, just maybe some slight warning signs, but some question marks, because it may just be there's a lot of volatility around the timing of shipments coming through. Now, that's just a little bit about where we're at with what's happening with our export performance, I thought I'll just very quickly talk a few minutes about New Zealand and then open it up, and then we can just go from there. So just I think the key highlights here in New Zealand is, look, we had the contraction through the middle parts of the year. It was quite deep and sharp. We have seen a degree of rebound coming through late last year and the early parts of this year. Ironically, a lot of that's been sort of driven by our export sectors. We are still yet to see that sort of domestic momentum sort of really get going. Like the consumer pickup, it looks like it's starting to happen, but it's pretty slow. And the housing market, which is usually pretty interest rate sensitive, has been fairly slow as well. And one of the challenges that we're grappling with here is that inflation's likely to hit 3% again in the sort of second half of this year. But because we've still got a fair bit of spare capacity around, particularly with people with unemployment, nudging above 5%, we're likely to still see those sort of medium-term inflation pressures remain quite contained. And our sense is that the overall impact of the tariffs will dampen inflation here a little bit. But it does mean that Reserve Bank's got a few, it's not straightforward decisions for it at the moment when it's dealing with a spike in inflation and just how our behaviour can respond to inflation. If we all start going, okay, 3% inflation, is it going to be 4? Is it going to be 5? Is it going to be 6? And if we start thinking in that way, then that starts to get ingrained a bit into inflation because we behave in a different way. So that's something the Reserve Bank's a little bit wary of, but it's confident that inflation should still gravitate back down. So just very quickly, that's the level of GDP quarter by quarter. And that yellow line is that's the volume measure that we normally focus on. You can see a fair bit of recovery so far, but we haven't fully recovered from that hit that we took last year. And look, overall, you can see, look, that line's not going up very quickly. It's a relatively gradual recovery compared to that sort of trend growth that we had, say, pre-COVID, when productivity growth seemed to be a bit stronger and our population growth was a bit stronger than what it is now. On a per capita GDP basis, I think like the slightly disquieting thing is that that's taking quite a bit of time to recover. We're getting weak growth back, but we've still got a bit of population growth, so per capita GDP is not recovering that rapidly. And it took quite a knock when you go back and look from about 2022 through to last year, so down about 5%, which is a bigger decline than what we saw on a per capita basis around the global financial crisis time. So it has been pretty tough for a lot of businesses, and I think the fact that we've had several years of pressure also, starts to stretch that resilience of some sectors as well, like construction being an example, which has been in a sort of fairly steady downturn for a couple of years. So this is that inflation picture, which is driving the Reserve Bank. So yes, inflation's looking quite low compared to where it was, and that's that yellow line, but you can see we're expecting it will bounce back up a little bit further and then start to come back down a bit closer towards 2% as we're heading over 2026. And it's a story of two different economies, that sort of traded goods economy. We've seen inflation there fall quite rapidly over 2023 and 2024. It's now rebounding to a sort of more normal level, but in the short term, there's also a bit of pressure from food prices. And it's not just the fact that cheese and butter prices are going up on high global dairy prices. We are seeing a wide range of grocery prices go up as well. But what should help hold inflation down is just slowing wage growth, the continued degree of spare capacity in the economy, just meaning that cost pressures are coming down for businesses, and we should see inflation settle to a more normal level as we're heading through next year. So that sort of story of decelerating domestic related inflation pressures is still going to be with us for a time, but we've just had a bit of a rebound in those sort of import export related prices coming through. And so when we're looking at the Reserve Bank, unfortunately, there's not a lot more juice in the lemon we think that's going to come out in terms of interest rate cuts. We do think we'll see at least one more cut next month, and there's always the possibility of another one down the track. But the wholesale rates have been pricing something in around 2.75% or 3% endpoint for the official cash rate for some time. So even though the swap rates, the wholesale rates, which are very important for underpinning fixed term lending rates, they sort of basically been bouncing around the bottom for some time. So we've tended to see that those sort of term rates are sort of been sort of trading in a bit of a range, and they're sort of pretty much well anticipated anything that Reserve Bank's likely to do this year. So official cash rate still a little bit more to fall, but the term rates, have been sort of bouncing around the bottom for some time. So, look, I'll leave it at that, and I'm sort of really happy to sort of delve into any questions, because there's obviously a lot that we can be talking about in this sort of environment. So I'll leave it over to you.
Good. I'll kick it off with a question and encourage anyone, which is, in the US, it's been made fairly well public that Trump's having this big challenge to the Federal Reserve independence, and specifically thinks that they're way too conservative on inflation and on where they've set interest rates, and even says there may be as much as 3 percentage points too high on their equivalent of their OCR. How do you see that, as an international economist, dispassionately offshore? Is Trump crazy, as the economic press in the US thinks, or is there a reasonable argument that they are being too conservative?
Look, it doesn't look like on the outset that they're being too conservative. Look, inflation has essentially stopped going down. You're seeing some early signs that tariffs are starting to lift inflation a bit, and there's probably more of that to come as well. So the Federal Reserve has basically said, look, we think we can cut rates a bit further in the future, but we want to see what's happening around the impacts of tariffs. So, our view is they will cut rates, but it's not going to be another 3 percentage points. It may be another 50 basis points, if that, and there is a bit of wait and see for probably another 3 months. I think that what the Federal Reserve is finding is well, one, inflation's still been quite sticky. You've now got this added source from tariffs working its way through, and also the prospect of a quite stimulatory fiscal setting as well. So when you're talking about basically the government spending a lot more money in effect, mainly through sort of income tax cuts, if that's not offset by the tariff revenue, which is at the moment running at a $350 billion, $400 billion annualized rate, so it's not inconsiderable. But there is also that sort of risk of basically more expansionary fiscal policy that risks being inflationary as well. So the Federal Reserve's got a lot to try and juggle at the moment. So it doesn't look like they are being too cautious in holding rates. And look, when you look at what we're seeing here in New Zealand, even in Australia, the caution that the Reserve Bank of Australia is showing, because inflation is being slow to come down there. In the UK, they're facing re-accelerating inflation, mainly because wage growth is picking up a little bit. They've had some added sort of cost changes that they've made at a government level, which have impacted as well. So it's not easy at the moment, but I think the Federal Reserve at the moment is rightly being a bit cautious, because it's out of any country that's going to be affected in a positive way, shall we say, or have a positive increases to inflation as a result of what's happening, it is the US. The rest of us, could go either way, but probably be slightly negative over time.
Yeah, good. Other questions? I have one other New Zealand question for you, and as others are waiting, is I love economics, so I have a lot more questions. But your New Zealand chart, what I sort of thought politically is it's very important in 2025 for the current coalition government to start showing better numbers on economic growth. So to put it another way, in the sort of 2 years this November that they've been in, the economy continues to sputter. Like they're trying to make all the right sort of improve business confidence and make the right noises, even put some tax cuts in, but the New Zealand economy really hasn't responded. So I would have thought they're going to try to do everything they can, although they're quite constrained in the budget. Any comments on that intersection of politics and our economy, and whether there's upside as a result of that going to an election year?
Yeah. So I think if we're looking at, well, what's the economy likely to look like as we're sort of heading into, say, the second half of next year, and when that election cycle is really heating up, is it should be in better shape, but it's taking a long time to get there. So inflation, yes, that's going up to around 3%, give or take, in the short term. We should already see in the figures that will get released next year that inflation was already heading down before the end of this year, and should be looking more under control as we're getting near the election cycle. We should see growth showing through more strongly than what it is. It is definitely taking a lot more time to come through than I would have thought, and that's where I mentioned the housing market before. We've seen interest rates fall from 7 to 7.5% to sort of around about 5%, slightly below 5%. Now that's not particularly going to start a stampede of borrowing like we saw in say 2020, 2021, but it's come down materially and sort of changed the cost benefits of buying property quite considerably. But we've seen a very slow uptick in sales turnover, a much stronger borrowing coming through, but probably more because first home buyers and investors have been able to much more easily meet the sort of credit servicing requirements so much easier than what they were able to. I think so. Two things that I think we've got to bear in mind also from what's going to give the economy more of a tailwind is we've had so many people continuing to choose either a floating rate or a very short-term mortgage rate out of the view that term mortgage rates will still fall further, and it'll be an even better opportunity in the future to fix people the mortgage at a longer rate. So it has meant we've had a lot of people sitting on a relatively high mortgage rate for chunks of this year, but we do have a considerable amount of the fixed rate mortgage market rolling their mortgages before the end of the year, and we are likely to see just the average mortgage rate that's paid across New Zealand is likely to fall quite substantially by the end of the year, and that does mean that cash flows in that part of the household sector that's borne the brunt of the financial pressure over the last few years will have a lot more cash in its pocket. So that's one thing to bear in mind. It's just that lagged impact on household spending of falling interest rates is taking a while to come through. And in part because people have taken a firm view that there's a much better opportunity in the very immediate future to get an even better rate. And everybody seems to be very intent on picking the absolute bottom of the mortgage rate market. So there's that too. The other thing is that notwithstanding, the caution over the global environment, look, the on-farm income is pretty good at the moment. So, we're talking about a dairy sector where you're talking about, $4.5+ billion extra revenue. That's revenue, not necessarily net profit, from the last season, and revenues holding up at probably a fairly similar level over the season that just started recently as well. We can see farmers have a lot of spare cash washing around because they are outright paying down debt and they are building up their deposits as well. So they're really focusing on getting their sort of financial position into good order. And there's been a lot of deferred spending, investment, sort of fixed capital spending and maintenance to do as well. And you're likely to start to see that money increasingly trickle out into the community. And for meat farmers, similar story, but not quite as strong. And the fruit sector's been doing fairly well too. So we have got quite a good sort of export earnings out of many of our sort of land-based exports coming through, where we just haven't quite seen the spending impact of that fully coming through. So there's those two things coming through. I think probably the last point, Jonathan, is that when you're looking ahead, look, there's no easy ride, I think, for any government at an election. We have been in a position where the degree of spending that we've kind of baked in at a government level is quite elevated compared to where it was a number of years. It hasn't really come down that yet, really, as a share of GDP. The revenues have kind of started to catch up a degree. But when you're going ahead, if you're wanting to try and balance the books on at least an operating balance level, you've got some pretty tough choices, because if you want to go and, say, spend more money or cut taxes, or in some way reduce the sort of government sort of like net, I guess you could say reduce the overall sort of spend in some form or another. You've got to figure out how you're going to cover that cost. So if you want to spend a lot more money, you're going to have to raise a lot more money through tax and talk through that. And on the same thing, if you're going to cut taxes, you're going to have to go through that story of, okay, well, what other government services are you cutting, or where are the efficiencies you're actually finding? So I think it's going to be tough for both sides of the political spectrum to run an election next year, because this is not like a 2005 election where it was just, there just seemed to be money for Africa and everybody was making lavish promises on both sides, and it was just like, what flavoured ice cream did you want to kind of be drowned in around election time? We don't have that sort of environment, so it does mean it is challenging for anybody for the next, at least the next election cycle.
Good. Other questions? I have one more for you, and it's a little bit of a comment, but I'd be interested in your reaction, is that the international media is very negative on Trump and US economic policy and the chaotic nature, and you've noted in your presentation uncertainty. But when the group of us actually talked to the Republicans, you heard a different story, and it has to be, it's the perception, and you sort of figure out it's partly right. And the different story is, I mentioned the markets. The markets are at an all-time high. We've come actually through with a reasonable tariff structure, not punitive, but in that, you mentioned 15 to 20% range. It's going to raise a lot of money, so offset fiscal policy and really pay for the tax cuts. And no one's retaliated. We've managed to push through, this is like Trump administration talking, we've managed to push through tariffs to all these countries. And because of how good we are as negotiators, no one's retaliated. I mean, but might the US be like one of the real strengths of the world economy? Current administration thinks so.
Yeah, well, I suppose it's one way I would look at it is like there are some sort of good arguments you can run for, say, some of the things that Donald Trump has done. You can argue that, say, in Europe, there are countries where they have taken the view of, say, dialing back their defence spending quite considerably, with a view that the US will come to their rescue if needed, and a bit of pushback on that, which is what the US has done. You could say, well, you can understand the case for doing things like that. And also looking at the US and going, look, how efficient is the government bureaucracy there? It probably makes ours look incredibly efficient. So yes, is there a case for trying to overhaul it and reform it so it's more efficient and more more effective rather than a means to an end of providing lots of gainful employment for people in the Washington DC sort of broader area. With the trade stuff, look, yes, the US does run large trade deficits with many countries on a good side. It also runs overall services trade surpluses, and one of the ironies is like with Europe, it runs a trade surplus. It doesn't quite offset the goods deficit, but there's been very little focus on areas like that where the US does run a surplus, and the sort of talks around being fair on trade. And look, there is an argument that there are countries that overly protect themselves. Can India, justify 100% tariffs on some things when it's just such a big country now? What does it really need to be protecting itself to an extreme? I think the way I sort of reflect on what's happening in the US is it's like that sort of reputational kind of damage. I mean, it's been like we spent 50, 60, 70 years having the US be the person in the playground whenever the sort of like the bully in the form of the Soviet Union or someone's come up and tried to punch us. The US has like turned around and kind of thumped them in the face and stopped them. And now what we're finding is that the person who's protecting us has turned around and thumped us in the face. So I think one of the challenges is there's been a bit of a fissure of trust. So I think, yes, the US has managed to divide and conquer. Europe has talked about retaliating, but in the end sort of hasn't. The only one that has is China, where it has sort of kind of stood up and retaliated back because it has got bargaining position. But if you haven't had bargaining position, you've tended to wear a tougher deal. So I think the challenge for the US is, well, hey, sure, they might ride through this and everything settles down and they get a bit of tariff revenue and everything sort of moves on. But it's just now in this environment, so what's the longer term impact on other countries' relationships with the US? So we may need them for trade for a while, but are we going to be looking a lot harder at how we kind of reduce the impact that the US can have on us? Because I think that's probably the challenges as a country where you've sort of long thought of it as an ally. When you sort of look around at, say, Europe and others, is behaving in a very different way than what it used to be, and more looking at what can it get out for itself in an environment where actually you've been looking for someone who can stand up to, say, Vladimir Putin, counter, say, the territorial ambitions of China, for example, and now everything looks very transactional. And unless you're offering a good deal, are you going to get something in return? And I suppose it's got that, rather than strong focus on relationships, it's got a lot more transactional. What can we get out of it? And that's why I think with longer term, what does that actually mean for the US and its place in the world? What are we now doing with all the shifts that the US is doing on sort of clean tech and other areas and AI? Are we is China going to be able to sort of pick up a baton and suddenly run with things because of changes in US domestic policy, which may in the long term have some consequences that haven't really been thought through at the moment? So I suppose that's what I'd probably reflect on. It's there's a sort of longer term sort of story about what comes out of this with the relationship and the trust aspect. And it may be that something that it passes on to something, a new chapter after the next election or not. It sort of really depends on how relationships evolve. And so Fran, I can see you've got a question.
Yep.
Are you just on mute, Fran? Yep.
Yes, I can. Thank you. Hey, you may have covered it earlier, and I'm sorry, I was a bit tied up when you began. But the EU-US deal, what's your feelings about that and the ramifications potentially for other deal making?
Yeah. So look, I think in the end, this is where I think Jonathan's point about everybody's just like relieved and the markets are all high. We're in a bit of a situation where everybody was fearing that to have all their limbs chopped off, and they're relieved that they've only lost one. So everybody's just euphoric. It's a little bit like that. I sort of feel for the EU. 15%. They were trying to aim for the 10% that the UK UK got. They were sort of, I think, quite shocked at the fact that they're being threatened that it might get 30 and that negotiations weren't seen to be going too well. And then when Japan settled for 15%, it sort of was probably realistically about the best they could do. So I think it's in that range where it's a bit like for us with that 10%. It's not helpful, but you can probably over time kind of get around it. But I think when you're looking at, when you're looking from here on with other countries and what are they going to settle for, like say South Korea will be another big country in that sort of where it's kind of both a defense ally, but also an economic competitor, a bit like Japan and the EU are, and it's probably not going to do any better than say 15%. Going forward. That's probably one of the last big ones that matters, I think, from our point of view. For China, look, I think it's in a very different position where it's probably not going to do any better than that sort of deal anyway. But they are the only ones that have really sort of stood up and just punched back, and they punch back pretty hard. And I think they are doing it from a point of view where someone feels that they don't have anything to lose. They're sort of one of the worst opponents to be up against because they're very hard to beat. And I think sort of China's showed a little bit of that angle where it's just said, we don't care what this costs us or how much we get hurt, we're going to win this. And they've sort of, I think, shown a bit of that attitude. So I think there'll be a lot of negotiation there, and particularly around the rare earths as the sort of couple of aces that China's got in the hand. And I think China generally feels that it can come out of it better. Like for China, this is quite a strategic opportunity to be looking at, okay, who can we peel off for the US? Because many countries have had their confidence in the US as say a trade destination or a security ally. It is being, people are asking questions a bit now. And it does give China that opportunity, a bit of an opportunity. So, I imagine China will drive a hard bargain, but it may struggle to get better than that 15%. I think from our point of view, as long as it's, if it's in that 15-25%, it's probably manageable in terms of what it does to China's economic growth. And so what's the flow on to us? But I think where we've started to see things settle, because people didn't band together and, fight back together and negotiate together. Trump's just picked everybody off one by one. And sort of done the sort of typical tactic of threatening with 100%, settling for something that everybody feels quite relieved about, but still gives a reasonable win from a Donald Trump's point of view.
Yeah, I guess the thing with China is it can also apply countervailing tariffs and has done so, and it retaliates with serious intent. Very interesting. Needs somebody, whoever, to stand up to Trump, in my view.
Well, you've had that. Probably, unfortunately, it's probably just like one area, and at a different strategic place than say Europe, Japan, UK. If you banded them together, probably are, because other people have got their own separate issues with China over different things as well, which makes it a lot more complex. But look, they have shown that they're prepared to push back and wear the cost. And not being a democracy, you can tolerate a lot more pressure on your population or fallout from the pain without having to necessarily pull back on your external position. So China has been in a relatively strong place, and I think that's what they realised. I think they were much more prepared for this than the US administration was. The moment the tariffs started escalating and China just slapped back and just kept slapping back and just said, we'll just keep punching back. You got up to 145+% tariffs very quickly, and just that realisation that actually this isn't really going to work even for the US. And you've had that sort of pull back. But they are the only country that's probably had I think the ability plus, I guess, courage to do it. as well, because it's high stakes. It's high stakes for Europe as well if they started slapping back. Because what are they going to do if the tariffs escalate and escalate and escalate? They're probably in a much more vulnerable position, particularly say the automotive sector.
But the vulnerability is also on security. I mean, it's not simply an economic vulnerability. I mean, their vulnerability is they rely on the United States as a security blanket. China doesn't. So,
and
plus, I think when you're talking about 1/5 of the world, it does give you a certain amount of clout, irrespective. Yeah.
So I think we've got another couple of questions. I think
we also have a question from Justine. I don't have everyone on my screen, so thank you, Fiona. Justine.
Thanks, Jonathan, and hi, Nick. Thanks for the great presentation. It was really interesting. Justine Errol from Fonterra here. I just had a question around sort of both the outlook on inflation and sort of the equity and bond markets. I guess just interested that we haven't yet sort of seen the US inflation rate kick up in the way that we might expect given the sort of increase in tariffs, and also while we saw sort of pretty significant reaction from the bond and equity markets kind of back in April, we haven't sort of seen a similar reaction or much by way of reaction sort of in response to recent developments. And just interested in your perspectives on kind of why that is. Are we expecting to see inflation rates sort of start to come up over time as the tariffs flow through into the domestic US economy, or are there sort of other factors at play? Thanks.
Yes, we are expecting that there will be more inflationary impacts that come through. It's been helped a bit by the fact that for a period you've sort of quickly pulled tariffs back to, for most people, a 10% level. So that has helped. But the last inflation figures that we saw, you could see there are some tentative signs that imports were starting to be affected by the or imports of consumer goods were starting to be affected by the tariff. So I think it'll be perhaps more of a slow burn. And what we've got to remember now is that we're now going, we had that period of quite high tariffs that didn't last very long. We settled back to about 10%. We're now going to be going up to 15% for two significant exporters to the US. We still don't know where China, Canada, and Mexico are ending up as well. And the impacts look like they're going to be a bit uneven as well. So at the moment, we're sitting with 50% tariffs on key metal imports and 25% tariffs on cars. So you can see that sort of heavy manufacturing and automotive sectors being affected quite a bit compared to say some other markets. So say the consumer product market, which is probably a bit nearer and dearer to your business, probably less so affected, given that say some of our sort of key global competitors in dairy are not getting tariffed too high. European Union at about 15%. So look, I just say it looks like just a slow burn coming through. And when it comes with markets, like bond markets have been dealing with risks of inflation, which they're probably a little bit less worried about at the moment. They've also been dealing with, as Jonathan touched on before, it's just this whole undermining of the Fed chair Powell and the musings about firing him, and that's pushed bond yields up at times as well, out of a view that if he's kicked out, then that's not good for the independence of the Federal Reserve. Anybody who comes in is likely to probably be a bit softer on inflation, which might be good in the short term in terms of holding rates down, but longer term could mean more persistent inflation and bond yields needing to go back up. So we saw this perverse reaction of short-term yields coming down a bit, bond yields going up when there was sort of like some quite serious talk of him going. So look, I think bond markets sort of settled into a view that look, there'll be more rate cuts coming, but they're not going to be nearly as much as what was thought last year. There's been some, I think, soothing of the risks, sovereign credit risks coming through from large debt levels. Or the loss of independence of the Federal Reserve, but you've still got bond yields a bit high, higher than where they were, pre-election as well. I think the equity markets one is probably the more challenging one to think through, because why have we got record levels of equities when two big things have happened? Is that right? We've decided we're going to slow global growth, including in the US. And some US companies will do well if they don't have any, if their import competitors are impacted a bit, but others are getting, affected hard. I mean, so much has been driven by the sort of Magnificent Seven and how they are doing, and Nvidia shares and the like is sort of one thing we've got to bear in mind there. But yeah, so we've decided to slow US and global growth. That's usually not a tick for equity. Equity markets, for one thing, and also there's not going to be as much easing in interest rates as what was thought last year as well. So you'd think that on two reasons that would normally, you normally think that lower interest rates and an environment of tranquility and predictability would be good for equity prices, but what we've got is the opposite. And it does seem to be there's just this, thank goodness we've got some deals. Even if the deals aren't necessarily good, the fact that we're getting some deals and getting some certainty seems to be seen as quite a positive for equity markets, notwithstanding the fact that what's happening is sort of probably overall compared to last year, on balance negative for equity earnings.
Good. I am sensitive that this was only supposed to go an hour. Thank you, Justine. I'm sensitive that this is only supposed to go an hour, so I think I'll close it up now. Nick, thank you so much in talking to us. What you've achieved is you've given us data that actually allows us to focus on the evidence, not the sentiment, but then also talked about the uncertainty on the outlook, what we know and what we don't know. So it's like I've gone to the eye doctor and you've given me a slightly better pair of glasses and I can see a couple of the rows, but not all of the rows on the eye sheet is the metaphor I'd use. But so thank you so much for spending the hour with us and talking about such a relevant and timely issue, economic growth in the era of tariffs.
You're most welcome. Thanks.
Thank you.
Thanks, Nick. Yeah, cheers,
Thanks,
mate.
Nick.
Well done.
Thank you.
See you.
Thanks, everyone. Thank you. Bye.
Bye.